I invested $50 million in Apple and Amazon 9 years ago. I made $500 million off of it. It's a 10-bagger. Not that hard. I'm not proud of it. All I did was buy these digital networks when 99% of the people didn't agree with me, when they were unstoppable, and I waited. And I swore to myself, if I ever saw another one, I wouldn't just do it personally. I would put my company into it. I think the people that lived the last decade, the first decade of Bitcoin, have been scarred by their experiences because they had a very volatile first decade. But I think that those are misleading because the system has evolved. Institutions have come into the marketplace. And since March of 2020, it's a totally different asset class. If you look at the chart since March, it goes up 50%, down 25%, up 50, retraces 20, up 60, retraces 25, 30, up 50, retraces 25. And so it's actually simply growing. The way I explain it to people is if you studied LeBron James's career from age 9 to 18, he was talented but volatile. But it would be a mistake to extrapolate from the first 9 years or first 10 years to the next 10 years. From age 18 to age 28, LeBron James was the greatest athlete in the sport and not volatile at all, except in a good way. If you're staring at a basketball court, watching stuff move, he's actually making everything happen. He's the volatile game maker that's destroying everybody. But it's not a bad volatility. You want to get rid of volatility? Put a lump of rocks on the basketball court. You have no volatility. So I'm not terribly concerned with the volatility. I think there'll be accelerations and pullbacks, but the institutions are collaring it on both sides. The capital is not consumer leverage capital, day traders. The capital right now is insurance companies, big public companies. We're coming in to buy it forever. Like, ask me when I'm going to sell it. Never. I'm not going to sell it ever. And so the narrative has rotated. Long-term institutional deep pockets, and the asset class has matured. And of course, the law of large numbers say a $1 trillion entity has more inertia to it than a $100 billion entity. And what do I expect to happen? I expect it will grow aggressively toward gold, and it will flip gold, and then it will demonetize gold and subsume gold. And probably it'll be first $10 trillion and gold is 10 trillion. Then it'll be 20 trillion and gold will be 5 trillion or 4. And gold will eventually become an ornamental metal. Bitcoin is going to suck the monetary energy off of negative yielding bonds. I ran a survey on my Twitter. I got 65,000 responses 2 days ago. I asked people, where did the money come from you used to buy Bitcoin? 49% is stocks, 20% is gold, 10% is bonds, 19% is property. Basically, stocks are going to be negative yielding if you're value stocks because they can't keep up with the rate of monetary expansion. Everybody knows bonds are destroyed. Ray Dalio just told the world they're all negative yielding. By the way, he thinks they're negative yielding versus CPI. The real point is they're negative yielding versus the cost of capital or the rate of the monetary supply expansion, which is like 15 to 25% a year. They're screaming value destroyers. So I think that Bitcoin goes to 10 trillion and it goes as fast as it can. And then it grows 50, 60% a year toward 100 trillion. And it slows down from 200 to 150 to 100 to 80 to 60 to 40. You saw Google and Amazon growing at 20% a year off of large numbers consistently for the past 5 years. I think when it gets that big, it'll be growing 20% a year. And eventually it'll subsume the total addressable market for treasury assets. And then it will be growing at an organic rate, 5, 6, 7%, a fair cost of capital. I think the single most important thing you can do is estimate the annual rate of money supply expansion every year for the next 8 years. And if you think if that's 15% going to 10, going to 5, going to 2, going to 0, then you're going to stick toward a traditional portfolio. But if you think that money supply expansion is going to be 15% consistent, then you got to go to scarce assets. Bottom line is, I don't think bonds or real estate work as a store of value in a monetary inflation environment because they're both, one of them's a coupon and the other one's pegged to CPI or capped at CPI. I think that value stocks are, you've basically got to invest in an index of equities that are going to grow, or you got to invest in scarce assets. And if the growth rate of the money supply is 15%, you better find a portfolio of equity that's going to grow 15% or better if you're going to store value in it. Otherwise, I would invest in trophy assets, buy your house on the beach that you want to live in the rest of your life, because that'll always be valuable to you with leverage. I think you buy scarce digital, probably like Bitcoin. You buy things that are absolute, buy something that a rich person is going to want to buy from you in a decade. Ask yourself that question. I'm not buying your New York municipal bonds yielding 2% in a decade, and you're going to get a negative 15% real yield. So I would think in terms of that: trophies, equities, and then scarce assets. And obviously I'm biased. I think Bitcoin is the best property in the world. Figure out what your risk tolerance is for it, buy that much of it, and then diversify the rest across other things you know and you're comfortable with. Bitcoin is the world's best treasury asset. It's like 100x bigger than the next thing. The risk is 1,000 times less than the next thing. The addressable market is 100 times bigger than it is right now. It's its own thing. Everything else in the crypto universe is venture capital. If you have a venture capital portfolio, if you have the wherewithal to invest in crypto ventures and you want to study it, well, in my opinion, they have 100x less addressable market and they're 100 times more complicated. But if you want to do that and you have the capital to do it, have at it. If what you want to do is just buy a bar of digital gold and wait, I mean, Bitcoin is better gold than gold on a big tech network, right? You just buy a bunch and you wait. Like, we're not crazy. The point is, it's the world's first digital treasury asset. There's $100 trillion worth of treasury assets that are negative yielding debt or zero yielding debt or cash. And that's like, in essence, minus 15% real yield. All the bonds are broken. All the treasury strategies are broken. This is the solution to $400 trillion worth of investors' problems. They've all got the problem. It's the solution to 7.8 billion people's problem. They're all generating salaries in cash, which is debasing at 15% a year. And it's the most disruptive technology in our lifetime. And, you know, I've been on your show. You had me talking to you about 8 years ago. We're talking about Apple and Amazon. If you recall, you could probably pull the clip. I invested $50 million in Apple and Amazon 9 years ago. I made $500 million off of it. You know, it's a 10 bagger. Not that hard. I'm not proud of it. All I did was buy these digital networks when 99% of the people didn't agree with me, when they were unstoppable, and I waited. And I swore to myself, if I ever saw another one, I wouldn't just do it personally. I would put my company into it. So we ran into the biggest crisis of our career in 2020. I had $500 million in capital. I saw a digital network, which I think is 100 times better than Google or Facebook. It's Facebook for money. When Rupert Murdoch goes to Facebook, he doesn't bring 1 billion friends. He's not paying $100 million a month to watch Netflix. Okay. When a billionaire shows up to Bitcoin, they buy $1 billion of Bitcoin. It's a bank in cyberspace. It's self-monetizing. And so I saw that. We bought some. It's working. There's an institutional rotation. All the institutions have the problem. They're all buying it. That's why it's gone from $4,000 a coin to $60,000 a coin in 12 months. And quite frankly, I think it's the biggest thing of our lifetime. For example, if you'd asked the same question to Jeff Bezos in 2003 and said, you know, like, you just had an 80% loss in Amazon. Do you ever wish you sold Amazon in the year 2001?
Yeah.
You know, Jeff Bezos could have sold Amazon in the year 2000 and avoided a 95% loss. Do you wish he did?
That's true.
But you see how foolish that is, right? For example, Mark Zuckerberg, you know, could have also sold Facebook just after the IPO and avoided a 50% loss. You know, in fact, Jeff Bezos could have sold Amazon 5 different times and avoided an 80% loss. And if he'd sold at any one of those 5 times, he wouldn't be one of the richest people in the world. So I think that trying to time the market is a trader mentality. But if you look at all the richest people in the world, they're not traders. I mean, Bill Gates, Steve Ballmer, Jeff Bezos, Elon Musk, Mark Zuckerberg, Larry Page, name the person that traded their way to that situation. You can't really do it. Like, trying to time the market is ridiculous. If you look at statistical analysis of Bitcoin or the S&P, I think the conclusion generally is that like 80% of your returns come in like 1% of the days. So if you miss the top 3 days of a year, you might lose 80% of your return. If you miss the top 6 days, you lose it all. So the way this is going to work is it's going to look like you're not making a lot of money 98% of the time. And then you're going to wake up one day and you're going to find out that the sovereign wealth fund of some Middle Eastern country just bought $10 billion of Bitcoin. It's going to double or it's going to triple. And then you're going to be kicking yourself and screaming, saying, oh, well, I could have bought it at blank and I didn't buy it at blank. You'll be angry. I think that trading mentality is just really an awful mentality for anyone that, if you're not running proprietary algorithms on high-speed computers. Like, I get it if you're a high-speed computer trader and you're like slicing a tenth of a penny 1 billion times an hour. Like, I get that kind of trading. But for 98% of the population, people don't have any proprietary edge to trade. And so generally they all get beat by the market trading. People want to invest in something that they understand, that they can trust. So if you're going to be a theme park company, that's what you should do. If you're going to be a movie company, if you're going to be an oil company, you should be a pure play and you should focus, in a laser-like way on that, because that allows a rational investor to put you in their portfolio. For example, maybe you hate Bitcoin. If MicroStrategy has a strategy, which is we're long Bitcoin, we're levered long Bitcoin, well, then that's good, right? Because now you can short us. It's not a bad thing for people to short your stock, because if they short your stock, eventually they're going to have to cover. On the other hand, maybe they like Bitcoin, but they think it's 99% likely to fail. Think about it. You have $100 million. So you put 1% of your portfolio in it, and you want to find someone that actually is pure long Bitcoin. You see? So if we're transparent and predictable, then we allow a rational investor to allocate their portfolio rationally. And they just don't want us to be unpredictable. What happens if we become unpredictable? If I'm predictable, you might meet with me, understand what I'm going to do, and say, I wanted to put 5% of my portfolio into Bitcoin, and you might actually invest $5 million after a 1-hour meeting, right? But if you met with me and I said, I'm a genius and I can trade everything and I know when to sell and I know when to buy and I'm going to time the market and I have all these algorithms, you're like, well, maybe you do, maybe you don't. But 95% of the time, those things don't work. And the point is, I have just, if you're the investor, you want to hedge the risk. You don't want the management team to hedge the risk. I'm a black box. So after you meet with someone that says they've got some wacky, complicated trading algorithm, instead of actually investing $5 million, you invest zero and you study it for 500 hours. And so let me put it a different way. You could probably raise $1 billion in one day if you're predictable, even from people that don't even like Bitcoin. Whereas if you're unpredictable, you could work for 1,000 days and raise nothing. The world wants certainty. It wants clarity. It wants conviction, and it wants you to execute with focus. So it happens that we believe in Bitcoin, but there are plenty of people that trade our stock. You could buy our stock and go long our stock and short Bitcoin. You see, this crash is going to cause a lot of clarity to form there. First, the community is getting educated, right? I bet you everybody in the crypto community today knows the difference between a dollar in the bank and UST. And I bet you they have an intelligent conversation about the difference between Circle and UST and the business model of the two. And we saw last week, Tether had to redeem billions and billions of dollars of Tether. And they could, right? So they could. But if you had actually tried to redeem $7 billion of UST in a couple of days, well, people tried to do that and they couldn't. So I think the industry got educated, but also I think that there's a lot of people that would like to issue stable coins. Like Caitlin Long's bank would like to issue stable coins. And if you look at the banks like Silvergate and Signature, they're FDIC insured banks, but they can't issue stable coins. So, and if you look at JP Morgan and Goldman Sachs and Citigroup, they can't issue stable coin. Now, if you roll the clock back 6 months, the president's working group put out a memo on stable coins. And when they put out the memo, they said, we'd like for FDIC institutions to issue stable coin. Now, putting aside whether you agree with that or not, there's been a regulatory deadlock on Capitol Hill. I think that most regulation is going to create turmoil for the 19,500 cryptos. There's going to be a shakeout. So regulation generally is good for Bitcoin. and it's difficult for the rest of the cryptos. They're on the opposite side. But it is possible to construct a very profitable crypto exchange and a very profitable cryptocurrency, a stablecoin business, and a very profitable set of crypto securities with regulation. It's just that's going to be a lot more work. I think that generally just about all regulation that's contemplated anywhere in the Western world is going to accelerate mainstream adoption of Bitcoin. Bitcoin should get 10x bigger and then 100x bigger. And the thing holding it back is the fact that there's no regulatory clarity in the crypto industry. So yeah, I'm not really concerned about the regulation.